So that's analysis, common size analysis using percentage distribution. You also want to look at percentage change. What has happened to those revenues over time? If you look in, if you're looking at a CAFR, a comprehensive annual financial report, it will have a statistical section, and one of those schedules will show government-wide accrual-based revenues for the past 10 years. You can see here the current year is boxed in over here on the right, and the earliest year in the 10-year period is over here. These are the program revenues in this particular statistical section schedule. You'll also need the general revenues, the taxes and other general revenues that are on the latter part of the schedule. I think this may be, if not the same, very close to the one that is in the analyst guide. Percentage change, as you remember, you start with the most recent number, you subtract the earlier number, divide by the earlier number, and that gives you your percentage changes. Percentage changes over the past 10 years for this government and revenue total are almost 29%. That's kind of low. I mean, I'd expect for a 10-year period maybe to see 29% after adjusting for inflation. But this is, without accounting for the the increase in prices over time, just a 29% increase. So maybe it's not an entirely realistic example, but it'll serve. What I like to do to eyeball these numbers is to start with that total number, the 29%, and look for changes that are, either much higher or much lower than that. So, for instance, the other taxes, which grew 65%, so that's, I think, if I remember correctly, that's going to be that public service tax, for instance, and there may be something else in there as well. They grew considerably faster, but they're pretty small. They grew off of a very small base, and in the most current year, they're still only $4.6 million out of $126 million. Actually, so this obviously is a different example. Sorry. So forget what I said about the public service taxes. I'm not sure what these other taxes are. But the point that's important here is that they're relatively small. Whereas the bigger tax items like property taxes and sales taxes grew at a slower pace than revenues overall. Less than 20% growth in the property tax and just slightly more than 20% growth in the sales taxes. So between the most recent year and the earlier year, property taxes and sales taxes for this government became less significant. They'd be representing a much smaller percentage of total revenue than they did at the beginning of the decade. Capital grants and contributions have grown faster, but again, they grow at the same pace as the spending they're related to. It's usually a zero-sum game, and 4.3 million out of 126 million in total revenue isn't all that significant, so the fact that it grew faster doesn't mean much for this government. Unrestricted grants have grown faster, which is a good thing. Again, it's $8 million or so, not one of the biggest revenue items for this government, but that this is revenue they can use for any purpose they want, and so to see that growing faster and becoming a larger percentage of their revenue sources is a good thing. So let's take a look at what are probably the most key parts of analyzing the underpinnings of the revenues, which are analyzing revenue rates and revenue bases. When you look at revenue, it's the product essentially of two things: a rate that the government applies to a particular base. That base is some kind of economic activity like retail sales or the earning of income or the purchase of a home or changes in the value of their home or other property that's owned, consumption of water, if there's a charge for water consumption. These are the two factors that determine how much revenue they're going to have. And so a lot of analysis goes into looking at the rates that governments have charged and their perceived capacity for raising rates more if they need to, and what's happening in the bases as well over time, and where that's likely to go and what that's going to mean for the ability of that government to raise revenue. In the statistical section, governments will present information about their most significant own source revenue. Now, that'll give us some examples of valuable information for what in general is going to be their largest revenue source. It's possible that they might define most significant in a way other than just the aggregate amount, the one that produces the most revenue. But I mean, that's what most governments are going to do, but it's possible that they might base that decision on something else. Particularly if they have two large revenue sources that are close, they might pick the one that's smaller, for some reason that means to them that it is more significant as an own source revenue. For local governments, the vast majority of them are going to be reporting their property tax, and so there's a lot of valuable information about that. But anything that we're talking about here in terms of revenue analysis, you're going to want to try and do on their other major revenue sources. So if they have a sales tax too, for instance, or an income tax, or some other type of charge that produces a significant amount of money for them, you're going to want to try and get some historical information about the rates and the bases of those revenues as well. Unfortunately, governments aren't required to report that information in their statistical section as they are for their largest own source revenue. So you may have to dig in some other places in the CAFR and most likely outside of the CAFR to get that information. What you will see for that own source revenue, though, in the schedule is the total rate that the government charges, and if that is the product of some individual rates, for instance, a property tax with several different levies, like a general levy and a debt service levy, you will see those rates presented individually. And if you look at this government, you can see that its total direct rate dropped about 20, maybe a little bit more than 25% over that 10-year period. It was a little bit over $4 per $1,000 of assessed value, and it was just under $3 by the end of the 10-year period. The basic rate dropped a little bit early and then remained steady throughout that 10-year period. But this redevelopment debt service levy, so a special levy to repay redevelopment-related debt, I guess as the debt has gotten smaller and more has been repaid, that amount has been able to decrease pretty significantly. At one point, it was less than half of what it was at the beginning of the 10-year period. One other thing that you're also going to see here is if there are any limits on the government's ability to raise this most significant own source revenue, it will present a note on the schedule that explains that. And you can see there's a note just like that here that says that for this particular city, it can only raise tax rates by a majority vote of the city's residents, which may explain why the basic rate has been stuck at 1.66 all this time. You're also going to see that not only are the direct rates levied by the government itself presented here, but also rates that are levied against that same economic base by governments that overlap geographically with the government, at least in part. They don't have to overlap completely. For instance, this school district here might cover only one part of this city, or it may encompass all of the city and part of another city. The same, this county obviously is going to be much bigger than this city. And the reason it's important to see those overlapping rates is that there are kind of two dimensions when you're thinking about revenues. I mean, on the one hand, you're thinking about the government and its raising of the revenues and how much revenue it gets, and does it have the power to raise rates more? But if you're thinking about what the economy can bear, what taxpayers will be able to pay, you need to be mindful of the fact that they're not just paying taxes to this one government, or they may not be. They may be paying taxes to a whole bunch of other governments as well, to a school district and a county that are all taxing that same property in order to support their services. So being able to see those other rates tells you at a much higher level, the burden that that government's taxpayers are already bearing. And so you can see that, at least the total rates for these overlapping governments amount to $6.81 per $1,000 of assessed value. They're, more than double the direct rates that are levied by this government. The thing to be mindful of, and you can get some more information about this if you look at the schedule of direct and overlapping debt, because you'll get some information there about the percentage of the overlap. But it's unlikely that every citizen in this city, is paying this full amount. It may only apply to some of them because there's only a partial overlap. They're all probably bearing this tax, the county tax, because the city is almost certainly entirely encompassed within the geographic boundaries of the county. But you do need to be careful about assuming that all of these rates are in fact being paid by all of the citizens. So the total tax rate that they're facing may not be the sum of these two, which is close to $10 per $1,000 of assessed value. But that would be the max, and it's likely going to be something higher, though, than just the $2.98 tax rate that the city is levying directly. And that's an important thing to be mindful of when you're judging whether the economy can bear higher taxes. So that's revenue rates. Revenue base, then, the other major factor in determining what revenues a government is going to receive, is you're going to see that some tracking historically of the level of economic activity or the economic base that is being taxed or being charged. For a property tax, you're talking about the property value. And governments will present not just their total taxable value, but also major components of it. So for a property tax, you're going to see, at a minimum, probably residential apart from commercial. You may see a separate column that has tax-exempt property. In this case, they're showing these numbers, net of these values of tax-exempt property that are shown at the bottom here. You can do separate percentage changes over this 10-year period, looking at total. The total change in the assessed value of the property was 109%, but not all of the components of that changed at the same pace. Residential values grew faster than commercial and industrial values, for instance. And that's relevant because some governments may apply different tax rates to different types of property. What's most common is that commercial and industrial property tax rates are going to be higher than residential property tax rates if there is a differentiation between them. What you're also going to see is some information about what the actual value of the property is, because assessed value in most cases is a fraction of the actual value, because either the way that they assess the property values may produce a number that's less, so it's done deliberately, or assessed value may be calculated only every several years, and so what you will see in the schedule is an estimate of what the actual value is as well, and then what assessed value is as a percentage of that actual value. What other factors then besides base and rate are really important to pay attention to when you're judging a government's ability to raise revenue over time? One is the degree to which its major revenue sources are being paid by one or a few taxpayers or ratepayers. There is a schedule in the statistical section of principal revenue payers that covers the same 10-year period, but you don't see all the intervening years. When you look at any particular CAFR, you're going to see the most recent year in the 10-year trend, and the earliest year in the 10-year trend. And they will show you the 10 largest payers unless they can get to 50% of that own source revenue with less than 10, in which case they can show the number of principal payers that gets them to 50% or more. For this particular government, they don't have any real concerns here because their top 10 property taxpayers amount to just 5.21% of all of their taxable assessed value, and then conceivably then somewhere in the range of 5.21% of their total tax revenue. So if something were to happen to one of these companies or one of these property owners, for instance, if their building were to burn down, that wouldn't necessarily have a very significant impact on that government's finances because none of these payers really represents a very significant amount of that government's revenue. But let's look at another example. Here's one where its top 10 taxpayers, in fact, do represent a very large amount, and it's a growing amount too. It's almost 85%. In 2000 X9, at the beginning of the 10-year period, it was just a little under 2/3, or a little more than 2/3, 66.96%. So it's grown quite a bit, and the reason for that is this one taxpayer here that was a pretty significant amount to begin with, almost 40%, and now is almost 63%. What would happen if this entity were to go out of business and all of its property had to be revalued because it wasn't being actively used? That could really create some serious problems for this particular city. They would be in real dire straits if big business, as it's called in this example, were to go out of business. If you're looking at a property tax as the major own source revenue, then you're also going to get a schedule in the statistical section that gives you a sense of the government's ability to collect on those property taxes. This is information that will be much harder to get for any other tax revenue. But that information may in fact be available and something you'd want to look into. But it's a particular issue when it comes to property taxes because you're collecting them from homeowners, and the value of their home doesn't necessarily indicate their personal liquidity, their ability to pay their tax bill when it comes, especially when you're talking about people who live on a fixed income like senior citizens. They will still get a tax bill every year, but all they're getting is Social Security, maybe some pension payments, and it becomes harder and harder for them to make their property tax payments. And so what you can track with this is the government's what percentage of its property tax levy it collects every year. This first column here is the amount that's collected within the year of the levy, and they were collecting about 87% of the levy in the first year, and they were up to 92.62% by the last year in the trend. That's an improvement. That's a good thing. The higher that number is, the better, because that means those resources are actually going to be available in cash for the government to use to pay bills. The second column then will show the cumulative amount, and you can see that 10 years later they still haven't collected 100%. That's not unusual. There's always going to be some percentage that they are never able to collect. It would be unlikely to see any of these as 100%, and the numbers will grow over time. This one started at 90%, now it's 99.21. The previous year, 2000 X8, they collected 92.19% during the first year, and they collected almost another 4% in the following year, and still have almost 4% left to collect. And you would expect over the next few years that they would collect most of that amount, though unlikely all of it. What does this mean? There are at least two things that are useful about this. One is it tells you something about the fiscal management of the government. Do they do a good job of collecting, on their bills? They send out tax bills. Are they, managing to collect that money in a reasonable amount of time, or Are they doing a poor job of it and costing themselves some liquid resources? The other thing is that property tax collections are often a harbinger of economic problems. And so if you're looking at a trend, particularly in this number, the amount collected within the first year, and you see that that number is declining over a few years, that's often a warning sign that bigger problems are coming in the economy. So what other kinds of issues are important here? This issue of ability and willingness, uh, they're not the same thing. Ability means that legally, it can mean legally they can raise rates, or you look at their rates and you compare them to the rates of other governments that are nearby, and their rates are low, which gives you the sense that maybe there's some capacity to raise rates more, or you see that the economic base is growing, and so they have the potential to raise some more revenue here. That's ability. Uh, Whereas willingness, is talking about whether they're actually going to use that ability or that capacity to raise revenues. You could have all the capacity in the world and still not want to raise that money. And willingness, comes at several levels. There's political willingness. So, a government may have the ability to raise rates on its own, just by maybe a vote of its governing board, but it just won't do it. And you look historically and you see that they just almost never raise rates, and so they could have a tremendous amount of capacity for raising rates further without damaging the competitiveness of that government, but there's no reason to believe they will, because they've never shown any indication that they're willing to raise rates. There's also, the matter of the willingness of the taxpayers. We looked at that example before where you saw that the rates were stuck at $1.66 for like the last 8 years, and it was a government that could only raise those basic property tax rates by a majority vote of the citizens. Now, what we don't know is whether they actually put that up for a vote at any time during that period. They may not have asked, because maybe they don't have the political willingness to do it. Uh, or maybe they did it a few times early on, realized the taxpayers just weren't going to do it, and didn't want to damage themselves politically anymore by asking them to vote on more tax increases, and so they just stopped asking. That's something you would need to look into, look a little bit deeper to find out whether they have had votes like that and how they turned out. Uh, there are other economic factors that you're going to want to look at. You look at what has happened to personal income over time, because that's going to affect an individual's ability to pay their property tax bills. It has a direct effect on their purchasing. If personal income isn't growing very fast, it's going to result in slower growth, if not a decline, in retail sales, and that will lead to a decline in sales tax revenues. Personal income also is directly related to demands for services, particularly things that aren't considered to be, on the one hand, staple services, things that are more like luxury services. Citizens will tend to demand those more as their personal income is rising. If personal income is declining, that may suggest the need for certain services that are particularly aimed at people, of lesser financial means, like free and reduced price lunches at schools, or childcare, income support, Medicaid, things like that. The unemployment rate. Obviously, if the unemployment rate is going up, that suggests there are going to be people who, if it's a state, they're going to need unemployment insurance. They're going to receive payments while they're unemployed. It means they're not earning income. That's going to affect the income tax revenues. They're not going to have money to purchase as many goods and services as they used to, which is going to affect the sales tax, and they may not have the resources to pay their property tax bill when it comes due. The flip side of that then is employment. Looking at employment numbers for a government over time will give you a sense of whether the economy is healthy and growing or not. Construction activity and building permits, if that's rising, that is going to lead to growth in property values, which will lead to growth in property tax revenues. You're going to want to look at what's going on at higher levels of government, because that's going to say a lot about whether the government's going to receive intergovernmental aid or not. If the state government just passed a budget that slashes aid to localities, and you're looking at one of those local governments, that's something that's going to affect your conclusions about the health of that government's revenues going forward. And that's the end of the lecture. There obviously are other issues, other things that are relevant. Anything related to the economy is almost going to be relevant in some way to your conclusions about a government's ability to raise revenues going forward. There's almost nothing that's off limits if you can think about a way in which it is relevant to the financial health of that government, and in particular here, its ability to raise resources going forward, to finance its costs, its provision of service, and to repay its liabilities as they come due. Thank you.